Warren Buffett has delivered one of the clearest signals any serious investor could ask for in 2026. The market pullback that occurred earlier this year failed to create conditions worth deploying Berkshire Hathaway's nearly $400 billion in cash and Treasury bills. Buffett has seen Berkshire's own stock price fall more than 50% on 3 separate occasions during his decades at the helm. He described the recent decline as nothing by comparison. That statement is not casual commentary. It is a precise calibration of current market conditions against the historical standard he uses to judge real opportunity. This matters because most investors operate with a much shorter memory and much lower standards. They see a 9 or 10% pullback and immediately assume bargains have arrived. Buffett measures against deeper, more painful drawdowns that actually reset valuations across broad indices. Until conditions approach that level of stress, or until individual opportunities meet his strict tests of quality at a clear discount, the capital stays in short-term instruments earning a safe return. That choice protects permanent capital. It also preserves optionality for when genuine fat pitches appear. Retail investors who stay fully invested or stretch into marginal ideas right now are accepting risk without a compensating margin of safety. The Buffett Indicator, total U.S. stock market capitalization divided by GDP, currently sits near 230%. Buffett has repeatedly pointed to readings in the 70 to 80% zone as the area where buying stocks has historically worked very well for long-term owners. Readings that approach or exceed 200%, as they did in 1999 and parts of 2000, represent dangerous territory where the odds shift heavily against new capital. Current levels sit deep into that warning zone. This is not a forecast of imminent collapse. It is a statement of relative value. When the broad market trades at these multiples, the number of individual businesses available at prices that offer a meaningful margin of safety shrinks dramatically. Berkshire's cash position is the direct result of that math. Berkshire ended the first quarter of 2026 with that record liquidity precisely because the team refused to compromise standards. Greg Abel now serves as CEO. The transition has been executed without disruption to operations or culture. Buffett attended the May 2026 annual meeting as an audience member and received a formal tribute. A deepfake video even featured Buffett asking Abel why shareholders should continue holding the stock long-term. Abel's response emphasized the collection of durable businesses, the patient approach to capital allocation, and the institutional temperament that has defined Berkshire across decades. The system was built to outlast any single leader. That design is now being tested in real time. Buffett has already begun passing investment ideas to Abel. The recent position in Delta Airlines was not initiated by Buffett himself. Delta's CEO confirmed the investment aligned with the airline's long-standing goal of attracting patient, high-quality capital after the pandemic recovery. This detail reveals how decision-making continues to function. Ideas flow. Standards remain. Individual calls can come from different parts of the organization without lowering the bar. For any investor managing personal capital, the implication is direct. Develop your own process for identifying quality and demanding price discipline. Do not outsource judgment to any single voice, no matter how successful that voice has been historically. The insurance operations continue to generate float and underwriting profits. Recent commentary around potential succession in the reinsurance unit underscores that the core engine remains strong and is preparing for continuity. Berkshire's energy businesses have seen incremental demand benefits tied to data center growth in select regions. These operating advantages compound over time and supply fresh capital for future deployment. They do not alter the current reality in public equity markets. High valuations across many sectors mean the bar for new commitments stays elevated. The cash balance reflects that reality rather than any prediction about near-term economic outcomes. The single most important lesson for individual investors right now is this. Cash sitting in short-term treasuries is not a neutral or defensive posture when alternatives fail basic tests of value. It is the most aggressive allocation available. It preserves purchasing power and creates the ability to act when others are forced to react. Most retail accounts never build this kind of dry powder because the psychological pressure to stay fully invested feels constant. Financial media rewards activity. Brokerage platforms reward trading. The result is portfolios that compound at far lower rates than the businesses they own would suggest. Buffett's record demonstrates the opposite pattern. Long periods of inactivity punctuated by concentrated, high-conviction deployments have produced extraordinary results over decades. That pattern is repeatable at any scale if the temperament is present. Consider the Apple holding. Berkshire first purchased shares roughly a decade ago. The position has grown into the largest equity investment through appreciation and disciplined additions. Buffett has publicly credited Tim Cook with creating enormous value for shareholders. That outcome did not come from trading around quarterly results or reacting to macro headlines. It came from owning a high-quality business with durable competitive advantages through multiple cycles. The same principle applies to any portfolio. Identify businesses you understand deeply. Calculate conservative ranges for intrinsic value. Wait for the market to offer a clear discount to those ranges. When the discount appears, act with size. When it does not appear, remain inactive. This is not complicated. It is simply difficult to execute because it requires emotional control most investors never develop. The 50% plus drawdowns Buffett referenced did not occur in obscure or distant periods. They were real crises that produced maximum pessimism and forced selling across the market. In each case, Berkshire maintained liquidity and the willingness to deploy it into quality assets at depressed prices. That combination drove the long-term compounding of book value. The current environment has not yet produced equivalent conditions. The recent pullback compressed valuations only modestly. Many sectors continue to trade at multiples that leave little room for error. That is why the cash position stands at record levels. When the next genuine reset arrives, and market cycles guarantee it will arrive, the capital will be positioned to act. The question every investor must answer is whether their own capital will be similarly positioned or whether it will already be committed at elevated prices. Build the habit of rigorous self-assessment. Review every position, and ask whether you would initiate that same position today with fresh capital at current prices. If the honest answer is no, the position does not belong in the portfolio at its current size. Hope is not a strategy. Many accounts remain overweight holdings that were purchased in different valuation environments simply because selling would realize a loss or require admitting an error. That behavior destroys compounding. The correct action is usually to reduce exposure to levels you would willingly own at today's prices. This discipline feels uncomfortable in the moment. It protects capital over full cycles. Ignore the constant flow of macro predictions. Buffett has never based major capital allocation decisions on forecasts for interest rates, GDP growth, or political outcomes. He evaluates specific businesses and the prices at which they trade relative to conservative estimates of what those businesses will earn over time. You should apply the same filter. If you cannot articulate the competitive advantages of a business in simple terms and justify the current price with a margin of safety, you have no edge. Most market participants operate without that edge and pay for it through lower long-term returns. The transition to Abel does not change the fundamental requirements for success. The culture of patience, selectivity, and permanent capital protection remains the operating system. Share repurchases have become more relevant in recent periods as a use of capital when valuations allow. A dividend remains within the realm of possibility in the future without signaling any shift in philosophy. These are tools available to management. They do not alter the core message for outside investors. Demand quality. Demand price discipline. Accept long stretches of doing nothing when nothing meets the criteria. That approach has worked across multiple market regimes. It will continue to work. Common mistakes compound in expensive markets. Investors stretch definitions of quality to justify purchases. They lower their required margin of safety because opportunities feel scarce. They increase position sizes in ideas that are merely acceptable rather than compelling. Each of these adjustments erodes the asymmetry that produces superior results. Berkshire's cash position is the opposite of these adjustments. It reflects an unwillingness to compromise. Replicate that unwillingness in your own account. The market will eventually offer better prices. Your job is to be liquid and emotionally prepared when it does. Develop a written process for evaluating opportunities. Define what constitutes a wonderful business in your own words. Define the minimum margin of safety you will accept. Define the maximum position size you will take in any single idea. Then follow the process without exception. Deviations usually occur when emotions run high. Markets at elevated valuations create constant pressure to do something. The process exists to counteract that pressure. Investors who maintain strict processes outperform those who improvise based on headlines or peer behavior. The energy segment's exposure to data center demand illustrates how operating businesses can benefit from structural shifts without requiring Berkshire itself to become a technology investor. The advantages flow through existing infrastructure and customer relationships. This is the pattern Berkshire has followed for decades. Own strong businesses in growing end markets. Let the economics compound. Do not chase narrative-driven ideas outside your circle of competence. For individual investors, the same rule applies. Stay within businesses you can analyze with reasonable accuracy. Avoid the temptation to follow hot sectors simply because others are making money in them. That path leads to permanent capital impairment more often than it leads to outsized gains. Prepare for the next window of opportunity. It will not arrive with a press release or a clear bottom signal. It will arrive through a combination of lower prices and widespread pessimism. Your preparation consists of maintaining liquidity, keeping your process sharp, and resisting the urge to deploy capital prematurely. Berkshire's record shows that the periods between major deployments are not wasted time. They are the foundation that allows concentrated action when conditions align. Treat your own capital the same way. The goal is not to be fully invested at all times. The goal is to be correctly positioned for the environment that actually exists. If this kind of direct, principle-driven breakdown of capital allocation decisions is what you need to stay disciplined, subscribe to Investacraft right now. Turn on notifications. Every new analysis will appear in your feed the moment it is ready. Share this with anyone you know who is still treating a modest pullback as a major buying signal. The gap between reacting to price movements and actually applying a consistent framework shows up in results measured over full market cycles, not in any single month or quarter. Warren Buffett's comment that the 2026 pullback was not big enough is not a prediction of future market direction. It is a description of present conditions measured against a high historical standard. 3 prior drawdowns of more than 50% set that standard. Until valuations compress further or until specific opportunities meet strict tests, the rational stance remains defensive liquidity. That stance protects capital. It also creates the dry powder required for the next phase. Investors who understand this distinction will navigate the current environment with clarity. Investors who chase activity for its own sake will pay for it through lower compounded returns. The insurance float continues to grow. The operating subsidiaries continue to generate cash. The culture of long-term ownership remains intact under new leadership. These facts provide the foundation. The elevated valuation environment provides the constraint. Together, they explain why nearly $400 billion sits in cash and Treasury bills rather than in additional equity positions. The same logic applies to any serious investor. When the broad market offers limited margin of safety, the correct action is to wait. Waiting is not passive. It is the active decision to protect capital until conditions improve. That decision has defined Berkshire's success across decades. It can define your results as well if you have the discipline to follow it. Build your circle of competence deliberately. Write down the industries and business models you understand well enough to value with reasonable accuracy. Stay inside those boundaries. The temptation to expand during periods of high valuations is strong because opportunities inside the circle feel limited. Resist it. The businesses you understand best are also the ones where you can most accurately judge whether a margin of safety exists. Outside that circle, even experienced investors make repeated errors. Berkshire has always concentrated its equity investments in a relatively small number of ideas it knows deeply. Replicate that concentration rather than broad diversification into areas you cannot analyze. The recent pullback did not reset the dominant valuation metric to attractive levels. It did not produce widespread fear sufficient to create broad bargains. It did, however, serve as a reminder that markets move in cycles and that patient capital eventually gets rewarded. Berkshire's cash position is the clearest expression of that patience. Your own cash or short-term instrument allocation should reflect the same calculation. If the opportunities available today do not meet your standards, the capital should remain available for better opportunities tomorrow. This is not market timing in the speculative sense. It is valuation-based capital allocation applied consistently. Review your portfolio holdings against current prices with fresh eyes. Ask whether each position still deserves the capital it currently receives. Ask whether you would add to it at today's levels. Ask whether the business economics have changed in ways that affect long-term value. These questions should be asked regularly, not just during pullbacks. The answers will often reveal positions that should be reduced or eliminated even when the market feels stable. That ongoing cleanup keeps the portfolio aligned with current reality rather than past decisions. The transition at Berkshire demonstrates that institutional processes can survive the departure of a founder-level figure. Abel has the support of the board and the operating managers. The culture of decentralized decision-making within a strong central capital allocation framework remains. For outside investors, this provides continuity. For your own process, it provides a model. Build systems that can function without constant intervention. Define rules for buying, holding, and selling. Then follow those rules. The emotional benefit of having a clear framework is substantial. It reduces the daily pressure to react to price movements or news flow. Berkshire's approach has always been asymmetric. Limit downside through quality and price. Allow upside to compound through ownership of durable businesses. In an expensive market, the asymmetry is preserved by staying liquid rather than by stretching standards. That choice looks conservative in the short term. It looks aggressive over full cycles because it avoids permanent impairment of capital. Investors who chase returns without the same focus on downside protection often experience the opposite outcome. They participate in upside during favorable periods but suffer larger drawdowns when conditions change. The net result is lower long-term compounding. If you want more breakdowns that cut through market noise and focus on the actual decisions that move capital allocation outcomes, subscribe to Investicraft immediately. Turn on notifications so you receive every new piece the moment it is published. The investors who compound successfully over decades are the ones who maintain clarity when the environment is difficult. This channel exists to support that clarity with direct analysis rather than hype or predictions. Warren Buffett's framework remains the same under the new leadership structure. quality businesses, fair prices, patient capital, long-term ownership. The current cash position is the logical output of that framework applied to today's valuations. Your task is to apply the same framework to your own capital. When the numbers do not support deployment, remain inactive. When the numbers do support deployment, act with conviction and size. Everything else is secondary. The investors who internalize this distinction will navigate 2026 and the cycles that follow with a clear edge. The investors who chase activity or lower their standards will continue to underperform the businesses they own. The insurance operations, the railroad, the energy businesses, and the equity portfolio all continue to generate value. The cash balance stands as a deliberate reserve rather than an idle asset. It earns a return. It carries no credit risk in the short-term instruments Berkshire favors. It can be deployed in size when opportunities meet the standard. That combination of current earnings power and future optionality is what Berkshire offers shareholders. Individual investors can construct similar optionality by maintaining their own liquidity reserves and refusing to compromise on quality or price. The mechanics are straightforward. The execution requires discipline that most accounts never develop. This environment will eventually change. Valuations will compress, pessimism will increase, opportunities that currently fail the tests will pass them. Berkshire will be ready because it has preserved the capital in the process. You can be ready by doing the same. Protect the downside first. Maintain the dry powder. Keep the standards high. When the next window opens, the capital will be available to act. That is how serious wealth is built across market cycles. Everything else is noise that distracts from the only decisions that actually matter.